Hey there, it's Shireen, Mortgage Wizard. I know you haven't heard from me in a long time, and reason being, we got you tucked away into your nice, low, pretty rate. Not really much to reach out about besides catching up and seeing how you're doing. But the reason I'm reaching out is because I'm getting a lot of feedback from clients who have all-time high ratios for their debt. So just meaning that debt right now is at an all-time high, especially with interest rates on cars and credit cards the way that they are. The Fed funds interest rate is at an all-time high, and that's affecting all of our debt all around. Higher utilities, higher homeowners insurance, higher taxes, higher food, higher cost of living. So everyone is feeling the pinch right now. So I wanted just to send out this quick video and kind of go through what kind of analysis I'm doing with my clients to see if their low rate is really doing them a great job. I know we're attracted to those low numbers when it comes to rate. That's what we're taught, but that's not always the best option or strategy for us, especially when we have a lot of other debt. So I'm just going to take the next 2 minutes and kind of go through this scenario that I have for a client right now and show you what we're saving them and how in the end, taking a higher rate, because obviously rates are higher right now, doing a refinance cash out debt consolidation is actually saving them in the long run. So again, we can do this scenario for you, and we can play it any way you want. There's not one right way. There's just going to be the best fit for you and your family, knowing that a refinance opportunity is in the future. But I'll explain a little bit more about effective interest rate as well. So this borrower moved into their home in June of 2019. They had they refinanced in 2021. So you see there their loan amount. They got a nice, pretty little 3.25% rate with a $1,600 monthly payment, just principal interest. So unfortunately, right now they have debts to the tune of $101,000. So a car loan at 48, a few credit cards totaling about 50, 60,000. So monthly payments for all those items are about 3,000, a little over 3,000. So what we did was we looked at a few different options with paying off the car, without paying off the car. We looked at buying the rate down, not buying the rate down. So basically right now, $3,000 a month in regular credit card and car loan payments in addition to their mortgage payment. So just struggling a little bit right now, paying the interest only on the credit cards. It's not going to, you're just throwing money away at that point if you can't pay it down. So basically what we did was we showed them taking cash out at 75% of their home's value, with a new loan refinancing at a 7% rate, closing costs rolled in there. And when we calculated that, existing and proposed, so we took their debt balance and included it into their mortgage. And I am going to show you why that is not a bad idea. But obviously we're raising their rate, so their existing payment to their proposed payment is going up quite a bit. However, their overall monthly debt payments is coming down quite a bit. So these are just ratio numbers to make sure the loan works. But basically, we're saving them $1,558 a month. So that's cash in their pocket, monthly savings. And you say, and that's after calculating the lower payment to the higher payment. So if we look again at our savings table, this is where me being a certified mortgage advisor comes in handy, because we don't just look at those numbers we just went over, right? Everyone can read those. There's a little bit more behind the scenes going on. So if we take that $1,500 monthly savings and we apply it back, so you're already used to spending that amount, right? So we take that and we apply it back towards the mortgage. You're going to save 15 years and 7 months off that mortgage. You're going to pay that off in 12 years and 7 months. So when I say effective interest rate, your effective interest rate, I did not calculate it before this video, but it's going to be somewhere around 3%. So because you're saving so much money on interest, your effective rate is going to drop dramatically. So as you can see here, we're saving 187 payments. So instead of 338 payments, which is what we have left on our loan, we're going to have 151 payments. So basically it breaks it down for a 5-year calculation, 10 and 12. You may think like, oh, I don't plan on being here for 10 years. That's okay. You're going to have saved by, let's say, year 5, an additional 45,000 in interest. So that means you're going to be paying off your mortgage balance principal that much faster. So when you go to sell that house, even if you're not going to stay there for the full 12 years, you're going to have more in equity because you will have applied more towards principal than you will have interest. So you can see here that we have an effective interest rate. We have a payoff in 12 years by taking that $1,500 and applying it back towards the mortgage with a 12-year savings of $300,000. That is cash in your pocket, $300,000 savings. You can buy a second home with that. You can pad your retirement account with that. You can take some nice vacations, help kids through college. There's so many things you can do with an extra $300,000. You can equate that to winning the lottery. Some people look at it that way. So one step further, we have our existing payment at $36.12, and we take that payment and we times it by the number of months that we will have saved. Remember, I said we saved 187 payments. We take that, and that's dollars saved is 675,444, plus your consolidated revolving debt, which we all know that that would be higher because if we're just making the interest only payments, that number gets carried out. So total gain after 28 years and 2 months is 728,444. So basically it's just showing you another way to look at it, that if you would have paid this mortgage off or a similar mortgage with the amount of time it took you to pay off your debts, the total gained after 28 years is 728,000. So again, a pretty big number, a different way to look at it. If we just take this number and let's say, it is tight for me right now. I am not comfortable with putting all that towards the principal, and we just put 1,000 towards the principal and put $558 in our bank. And we all know you're going to keep getting raises and things like that. So, that number is conservative for what you can save. But even if we did that, we can take a look here, and the numbers are going to change, but they're still overall great numbers. So we're putting 1,000 towards the principal. We're putting $558 in the bank for a cushion, emergency fund, and we're still saving 12 years, 7 months. 151 payments, 255,000 over 15 years, 10 years. We can change it here, and we can say maybe we have a 4-year plan, and then maybe this is a 7-year. So depending on what we do here, our break-even point is 5 years. 7 years, that's the number. 15 years, that's the number. So I would love to sit down and do this with you. It does not take long. Few minutes over the phone just to kind of understand your situation, what your goals are, what you're looking to do, what the pain points are, and definitely see what we can do for you to help relieve some pressure, some debt. I will say that please do so sooner than later. Reach out. It doesn't cost you anything but time and a conversation with me. But once you start having late payments, whether it's on the mortgage, credit cards, or car loans, any of your debts that show up on credit, it just makes it that much harder. I mean, your chances of getting approved for refinance drop dramatically, at least by 50% the first month of late payments, and increases after that, because with late payments comes a drop in credit score. And when you have a drop in credit score, you're just closer to not qualifying. So please reach out if you have any questions, and I do look forward to connecting soon. Thanks so much.